Warning, stocks could get crushed. I don't think we've seen the last of this bear market, and I believe the probability is very high we see a black swan event that could lead to a stock market collapse. I'm going to reveal why in 2 simple, fast steps. Step number 1, let's go over this bizarre belief the market has right now and has had for quite some time. In the Fed, we trust. We just saw the CPI number come out yesterday. It was down to 8.5%. So the talking heads on CNBC and Bloomberg said, this is fantastic. This means the Fed is doing a great job. And if you don't believe me, editor, cut to the clip.
What do you think of this number? Has the train left the station?
Oh, look, good is good. Jay Powell so far is doing a great thing. A lot of the numbers have come down. Energy's come down. The price of the pumps come down. Travel's come down. Used cars come down. I mean, what more do we need?
So basically, they're looking at the yield curve and they're saying, see, George, all you crazy bears and Austrians, you don't know what you're talking about. Yes, the yield curve is wildly inverted right now, but listen, the Fed has raised rates, and this means the CPI is just gradually coming down. This is what the bond market's telling us. It's just going to just softly land the economy, just like a butterfly. And to be honest, I think we can go ahead and say the recession has been canceled because Jerome Powell is such a genius. And we should put all our faith and trust in the central planners at the Federal Reserve. And this is exactly what we saw with the market action. Let's look at a chart of the last 5 days. The Dow Jones Industrial Average. We go from August 5th to yesterday, call it August 10th. And on the left, we go from 32,400 up to 33,400. We start at 32.8, goes a little sideways, but this is really what I want to focus on. As soon as the news came out that the CPI had gone from 9.1 to 8.5, all the talking heads, like Clown Boy, came out and said, this is great news. They said, look, Jerome Powell is sitting here holding a sign saying, I love low interest rates. We could just see into the future, and we know that the Fed is going to pivot, bring rates back down. The economy is going to continue to boom. Everything's going to be fine. So bye, bye, bye. But when you scratch beneath the surface just a little bit and look at the details of the CPI report, you see it tells a much different story. Editor, go ahead and pull up a tweet from my good friend Danielle DiMartino Booth. She breaks down the components that made up this 8.5% CPI print. And we can see the things that really went down in price: airline fares, used cars, communication, and apparel. So let's think this through. How did the Fed bring down airline prices? How did the Fed bring down used car prices or apparel? You guys have been watching my videos. You know that especially apparel really has nothing to do with the Fed taking interest rates from 0% up to 2.25. These are all supply side issues. Look at it this way. Did the Fed somehow create more flights? Did they go to their garage and manufacture some more new cars to take the demand away from the used cars, so there's more supply of those used cars, bringing down the price? Did they somehow manufacture more semiconductors? Or did they go back to their sweatshop at the Federal Reserve and whip up some sweaters to send to Macy's? Absolutely not. And you can sit there and say, yeah, George, I know what you're talking about. But listen, the Fed, okay, they don't really control the long end of the curve. We've seen mortgage rates actually go down lately. But the front end of the curve, those short-term rates, they really control those. And taking it up to 2.25%, that has definitely led to some disinflation that we're seeing right now. But thank goodness the unemployment rate is still very low. So we're seeing inflation coming down with an economic boom. Well, okay, but let's look at something that would be heavily impacted by short-term interest rates, and that's credit card debt. And if you look, you can see that credit card debt is almost up to where it was prior to the cerveza sickness at an all-time high. This chart we're looking at shows that in Q1 of 2022, it went down to call it 850 billion. But if we look at the most recent Fed report, we see that credit card debt has exploded higher. It's up an additional 40 to 50 billion from where it was in Q1. And again, this takes us to a point very close to its all-time high prior to the cerveza sickness. And I'll be the first person to admit that I had my doubts the Fed could even get to 2.25%. But why did I make those claims? Why did I have that belief? Why was that my base case? Because I thought that bringing rates up to 2.25% or even higher would significantly bring down asset prices. And I didn't think we would have disinflation simply because the Fed took rates from 0 to 2.25. I thought we would have disinflation because this would result in the stock market coming down significantly, the housing market really starting to cool off as far as nominal prices, and this would lead to the demand destruction that would lead to the disinflation. So what we've seen is the stock market, although it did go down significantly, has come right back up to where it's close to an all-time high. And home prices are still at all-time highs, although the price increases are cooling off significantly. So my whole point is the Fed hasn't really done anything to lower stocks, housing, definitely haven't done anything to lower credit card debt, that's for sure. And that's the interest rate that they most control. So how can we say that they're bringing down the CPI? I don't think we can. I think the CPI is coming down as a result of the United States being in or very close to a recession. And the Fed isn't causing the recession. They're simply going to exacerbate the recession in the future. In other words, the mainstream media would like you to believe that the Fed will be able to bring down rates in the future because they did such a fantastic job bringing down the CPI without creating a recession. Therefore, the stock market should boom. And what I am saying is the Fed will lower rates because they have to, not because they can. Step number 2, but what about the Fed put? The pushback I'm going to receive is, yeah, George, okay, well, even if the CPI is down to 8.5% because the United States is in a recession or headed towards a very severe recession, and it's not because of the geniuses at the Fed, it just doesn't matter because at the end of the day, they can drop rates, they can do quantitative easing, and the stock market will never, ever, ever get crushed, crash, or collapse again. It's just the new world we live in, and you've got to get used to it. Well, I would argue the Fed put is really about psychology. It doesn't have much to do with the dynamics of their balance sheet directly. Therefore, if we're in a significant economic downturn, regardless of what the Fed does with their balance sheet or even with interest rates, the stock market will continue to go down. Let me give you some proof to back up what I'm saying. We've got a very rough timeline. That's about as good as my artistic skills get right there. We go back to March 1st of 2020. The S&P 500 was right about 3,090. This was right when the market started waking up to the severity of the cerveza sickness. We go to March 13th, the S&P had dropped significantly, went down to 2711, 2,711. And if you'll remember, this was a Friday. Sunday, the Fed had an emergency meeting, March 15th, and they dropped interest rates down to 0%. They dropped it, I believe, from 1.5 down to 0%, and they announced a massive quantitative easing package, $700 billion, according to CNBC. This was the largest Fed put we have ever seen in history. But what did the S&P do? March 23rd, after this epic effort by the Fed to prop up the markets, the S&P had gone from 2711 down to 2237, a decrease of 17%. Fast forward to the 25th, and the government, your drunk, insolvent Uncle Sam, starts passing the CARES Act. So now the market knows the government is going to come in with all of their funny money, all of the stimulus, the PPP, etc. What happens next? April 29th, the S&P is at 2939, an increase of 31%. So the question is, when we're in a recession, an economic depression, a downturn, in psychology, the market participants believe the economy is going to get far, far worse. Do we have a Fed put, or have we moved to a government put, where regardless of what the 900 PhDs do at the central bank, it doesn't matter. The market will continue to crash until the government comes in and says, we are here to deficit spend to oblivion. What we saw in March of 2020 is the latter is the only thing that mattered to the markets. And all the clown boys out there saying, bye, bye, bye. So we have to ask the question, in today's environment, where everyone is feeling the pinch from consumer price inflation, yes, it's gone down, but it's gone down to an extremely high level, relatively speaking. So in our very recent memory, we've got gas prices at $5, $6, food prices going up, shelter prices going up, all the things we need. We remember how it feels for real incomes to go down. So my point is, even if the CPI goes down to 5%, 4%, even 3%, do we live in a world today where if we have a significant economic downturn, the government, your drunk, insolvent Uncle Sam, can ride in on the white horse and start, quote unquote, printing money? I think the probability is extremely low. And I think this is what the bond market is trying to tell us, that in the future, maybe 2022, 2023, we will have a black swan event. We will have some sort of event like the GFC. It might not be a banking crisis, but it will be this severe. And we're at a point right now where the Fed put has expired and the government's hands are tied. Once again, the Fed will lower rates because they have to, not because they can. And even if they do lower rates, finally, the market will wake up and have that Wile E. Coyote moment where they run right off the cliff. They keep going until they look down and see there is nothing but air between the market and the ground. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.